So, imagine you're looking at a car's dashboard. The speedometer says you're flying down the highway at like 120 miles per hour.
Right, which feels great.
Yeah, it feels great, but the check engine light is flashing red, and the fuel gauge is hovering right above empty. Do you keep your foot on the gas, or do you pull over?
I mean, I'm pulling over. You have to.
Exactly. But that's exactly the scenario we're looking at this morning with the Pakistan Stock Exchange.
Yeah, it really is.
It's August 5, 2026, and we've got this incredibly fresh, highly detailed stack of 4-hour stock charts and index data in front of us. And our mission for you on this deep dive is to basically figure out if this market is about to break records or just break down.
It's such a fascinating moment in the market right now because when you have a massive bull run like this, it's very easy to just look at a green arrow on a screen, celebrate the headline, and completely ignore the underlying mechanics.
Oh, absolutely. People just see green and stop thinking.
Exactly. But the truth of what's happening, the actual friction between supply, demand, greed, and fear, it's hidden deep in the micro details of these specific charts.
And we are going to dig right into those micro details. If you're listening, we're going to extract the mechanisms from this data so you don't just see a rising line on a graph.
Right, you'll actually understand the order books driving it.
Yeah. We're going to look at specific sectors, from cement and energy to tires, real estate, and telecom, just to figure out what's actually under the hood.
It's the only way to get the real story.
But let's start with the headline anomaly, because it is just staggering. I've got the KSE-100 index chart pulled up here. And for context, this tracks the top 100 companies on the exchange. The index is sitting at 180,014.93.
Which is just a historic psychological level to breach. 180,000.
It is wild. Just today alone, it's up 2,931.71 points.
Yeah, that's like a 1.66% jump in a single session.
Right. And zooming out, it's up nearly 26%, 25.85% to be exact, over the last year. But here's what I just don't understand.
What's that?
Well, I'm looking at the 4-hour chart, and for anyone picturing this, it's a chart where every single candlestick, every data point, represents 4 complete hours of trading.
Yep, but the 4-hour view.
And right in the middle of this beautiful 25% upward staircase, there is this massive, sharp dip. I mean, it looks like the floor completely fell out for a solid chunk of time. Why didn't this massive rally just die right there?
So that dip is exactly why we use a 4-hour chart instead of like a daily or an hourly one.
Okay, how so?
Because it filters out the frantic minute-by-minute panic of retail day traders. It gives you a much clearer picture of what the massive institutional funds are doing behind the scenes.
Interesting. So the big money.
Right. In a weak, fragile market, a sharp drop like that triggers a chain reaction of automated selling. Everyone just runs for the exit.
Yeah, full panic mode.
But here, the market completely absorbed it. It shook it off and rebounded right back over that 180,000 mark.
You say absorbed it, but mechanically, what does that actually mean? Like, who is stepping in front of a falling knife like that?
It means there is immense institutional liquidity just waiting on the sidelines.
Okay, stop right there. Liquidity waiting on the sidelines sounds like, I don't know, Wall Street poetry.
Fair enough.
Translate that into plain English for us. What is physically happening on the exchange?
Okay, think of it as massive pools of cash sitting in brokerage accounts tied to strict mathematical rules. Large institutional funds don't buy stocks emotionally.
Right, they aren't logging in and panic buying.
Exactly. They set up limit orders. Those are automated instructions to buy massive blocks of shares, but only if the price drops to a specific predefined discount.
Oh, I see. So they're waiting for the panic.
Yes. When retail investors panicked and sold during that sharp dip, they were selling directly into the waiting hands of those institutional limit orders. The big funds effectively built a concrete floor out of cash, caught the falling index, and just pushed it right back up.
Okay, that makes sense. But it also makes me incredibly skeptical.
Why is that?
Because if I see a 25% gain in a year, my brain immediately thinks, okay, we are in a bubble. A 25% gain in a year is like a car driving down the highway at 120 miles per hour.
It's exhilarating.
It is. But at what point do the wheels start wobbling? Because if I look at the volume bars at the bottom of this index chart, those red and green vertical lines that show how many shares are actually changing hands, they don't seem to be getting taller.
Ah, you caught that.
Yeah. So how does an index price keep going up to 180,000 if the volume of eager buyers isn't steadily increasing to support that speed?
That is the exact discrepancy we need to investigate.
Yeah.
Because you have to remember, the KSE-100 is just a composite.
Right, it's an average.
Exactly. It's an average of 100 different companies. So if the volume doesn't match the price surge on the macro level, it means the index is being dragged up by specific outliers.
Okay, so the engine might be overheating in specific spots.
Right. To figure out if the engine is actually healthy, we have to stop looking at the car as a whole and start looking at the individual pistons.
I love that. So if we're looking for the pistons, where do we start? We need to know what's dragging this index up.
You always start by checking the bedrock of the economy, which is infrastructure. And in this market, specifically, the cement sector.
Okay, cement. Let's pull that up.
I want us to look at two massive players. We have DGKC Cement trading under the ticker DGKC, and they're currently at 217.50.
Got it.
And then we have Lucky Cement, ticker LUCK, sitting at 451.50.
Okay, I've got the data for DGKC and LUCK pulled up, and the geometry here is almost suspiciously perfect.
It's very clean, isn't it?
It is. If you're listening, imagine drawing a straight-angled line connecting the bottoms of their recent dips, and then another parallel line connecting their peaks. They're just bouncing smoothly upward inside this tilted hallway.
Yeah, that hallway is what we call an upward price channel. It's a sign of a very orderly, very controlled market.
Okay.
But to answer your question about whether the broader market is in a bubble, we have to look beneath that price action. We need to look at the RSI.
The relative strength index. Let's define that real quick because people throw RSI around constantly on Twitter and financial news. It's not just a generic momentum score, right? Like, how is it actually calculated?
Right. It's a very specific mathematical formula operating on a scale of 0 to 100.
Okay.
It essentially calculates the average percentage gain of the up periods over a certain time frame, usually 14 days or 14 periods on a chart, and divides it by the average percentage loss of the down periods.
So if a stock goes up, say, $2 every time it gains, but only drops 50 cents every time it loses, the RSI score climbs higher toward that 100 mark.
Exactly. It measures the velocity and magnitude of the price change. Now, if an RSI crosses above 70, the asset is widely considered overbought.
Meaning it's running too hot.
Yes. It means the buying pressure has been so relentless, without any meaningful down days, that the buyers are likely exhausted. And conversely, if it drops below 30, it's oversold.
Okay, so where do our cement companies sit?
Well, the crucial data point here is that for both DGKC and LUCK, their RSIs are sitting right in the low to mid-50s. DGKC is at 57.75 and LUCK is at 52.84.
But wait, an RSI of 50 to 55 isn't just normal. Mathematically, based on what you just explained, that means the average gains and average losses are almost perfectly equal, with just a tiny, tiny edge given to the buyers.
Precisely.
So the order book is balanced. If the KSE-100 is sprinting, these cement stocks are like the marathon runners of the group. They're moving up, but their heart rates, their RSIs, are totally normal at around 50. They aren't gasping for air.
That's a perfect analogy. The buying pressure and selling pressure are matched, but they are stepping upward together in a very controlled way. It's exactly the steady foundation you want to see.
Okay, but this is where the math just doesn't add up for me at all.
How so?
If the KSE-100 is sitting at a historic 180,000, up almost 26%, but the foundational cement stocks are just casually hovering at a perfectly balanced 50 RSI, well, cement isn't pulling this index to record highs.
No, it's not.
Right. If the foundation is just taking a leisurely stroll, something else in this data stack must be absolutely sprinting to pull the aggregate index up that high. What is hiding in the rest of this data?
To find out what's pulling the index, we have to pivot away from infrastructure and look at the energy and auto sectors.
Okay.
Let's look at Pakistan State Oil, ticker PSO. They're trading at 353.50. And then Gandhara Tire and Rubber, ticker GTYR, trading at 35.15.
Oh, wow. Okay, I see the charts. The price lines on these two are going up, just like cement, but the momentum indicators underneath look entirely different.
Yeah, that's because you're looking at the Stochastic RSI now. This isn't the standard RSI we just talked about.
Right.
The Stochastic RSI is basically the derivative of the standard RSI.
Hold on. Derivative is a pretty heavy math word. Do you just mean it measures, like, the speed of the speed?
That's a great way to put it, actually. Yes. Instead of just measuring price gains versus losses, the Stochastic RSI measures where the current standard RSI is relative to its own highest and lowest points over a specific recent history.
So it's much more reactive.
It is hypersensitive. It's designed to flash extreme warning signs the very second momentum gets stretched beyond its historical norm.
And these are screaming extreme. I mean, PSO's stochastic RSI is at a blistering 95.41, and Gandhara Tire is right behind it at 94.12.
And remember, the scale cap's at 100. When these sensitive indicators push past 80, it signals heavily overbought territory.
And we are at 94 and 95.
Right. It means historically, the momentum is at the absolute peak of what this stock can normally sustain. And if you cross-reference their price charts, both PSO and GTYR are currently slammed right up against the very top ceiling of their upward price channels.
Let me push back on this, though, because if I'm a retail investor and I hear that a stock is heavily overbought, that just sounds to me like it's incredibly popular.
That's how a lot of people interpret it, yeah.
Right. Like, if everyone wants to buy Gandhara Tire, why wouldn't the price just stay high indefinitely? If I'm holding these, my instinct is to cheer because the line is going up. But you're saying a 95 stochastic RSI is basically a glaring check engine light.
It absolutely is a check engine light.
Uh,
And it comes down to the mechanics of the order book. Think of price momentum like a massive tug of war between buyers pulling the rope up and sellers pulling the rope down.
okay, I can picture that.
At a stochastic RSI of 50, like we saw in cement, you have new people constantly joining both sides of the rope. The tension is balanced. But at a stochastic RSI of 95, almost every single investor who has the capital and the desire to pull on the buy side has already picked up the rope.
Oh, wow. So there's literally no one left to add pulling power.
Exactly. You've run out of marginal buyers. The tension on the rope is immense, but the buying side is completely exhausted. So the moment just a handful of large investors decide to let go of the rope and sell their shares to take profits.
The buyers have no resistance left.
Right. The rope snaps, and the price drops sharply to find the next level of equilibrium.
That tug-of-war analogy completely changes the picture. So if the institutional investors know the rope is about to snap, who are the people still grabbing the buy side at an RSI of 95?
Retail investors, mostly. And they are driven by FOMO, the fear of missing out.
Just blindly piling in.
Yeah, they see the KSE-100 hit 180,000 on the evening news. They see oil and tire stocks surging on a chart, and they jump in blind. Meanwhile, the institutional investors, the ones who bought weeks ago when the RSI was at 20,
What are they doing?
they execute a strategy called distribution. They don't dump all their shares at once because that would crash the price before they can get out.
Right, they'd ruin their own profits.
Exactly. Instead, they slowly sell their shares into the eager hands of those retail buyers. The price might creep up a tiny bit more, keeping the retail buyers excited, but the big money is quietly exiting the building.
Man, so the retail investor sees green, but the underlying telemetry says the institutional fuel tank is completely empty.
That's exactly it.
Okay, so we've looked at cement, which is perfectly balanced. We've looked at oil and tires, which are completely redlining and running out of buyers. But, this makes me wonder, is anything actually struggling in a 180,000-point market? Or is everything just varying degrees of up?
That is one of the most dangerous assumptions you can make in a bull run. The rising tide of a 180,000 index emphatically does not lift all boats.
Really?
Oh, yeah. And to prove it, let's look at a fascinating plot twist within the TPL corporate family, and we'll put it alongside a telecom benchmark.
Okay, I have the data here. So we have TPL Corp, which is the parent holding company trading under the ticker TPL. Then we have its direct subsidiary, TPL Properties, ticker TPLP.
Yep.
And for a totally different sector context, we have Pakistan Telecommunication, ticker PTC. So let's look at the parent company first, TPL Corp.
Look closely at its price, and especially its stochastic RSI.
Okay, so it's trading down at 19.299, but the stochastic RSI, I actually thought this was a data glitch when I first read the file.
Oh, no, it's crazy.
The stochastic RSI for TPL Corp is exactly 0.000.
It is not a glitch. 0.00 is the absolute basement of the mathematical formula. It means the stock is maximally oversold relative to its recent historical range.
So going back to your analogy, the tug-of-war rope has snapped entirely in the direction of the sellers.
Entirely.
But this is where it gets so bizarre. I pull up the chart for its subsidiary, TPL Properties. TPLP has seen this massive, aggressive spike upward. It's trading at 14.88, and its standard RSI is sitting hot at 71.89. It's officially pushing into overbought territory.
Quite the contrast.
How is this possible? TPL Corp owns TPL Properties. That is wild. It's like throwing a massive party where the KSE-100 is the DJ, TPL Properties is dancing on the tables, and the parent company, TPL Corp, is sitting alone in the dark corner with its 0.00 rating. How does a market value pieces of the same corporate puzzle so differently?
You've just stumbled onto the mechanism of the holding company discount, and it explains exactly what institutional capital wants and what it completely avoids.
Okay, break that down for us.
When a large fund wants to invest in real estate right now, they want pure exposure to that real estate. They want TPL properties. If they buy the parent company, TPL Corp., they are just getting the profitable property arm.
What else are they getting?
They're also buying the parent company's corporate debt, their administrative overhead, and maybe other subsidiary businesses that are currently losing money.
Oh, I see. So it's like wanting to buy just a premium cut of steak, but the parent company forces you to buy the gristle, the bone, and the packaging too. And in this market, institutional buyers are just refusing to pay for the gristle.
That is exactly it. They will aggressively bid up the underlying pure play asset, the properties, and they will entirely ignore the parent structure. It shows you that index numbers hide individual stories. You can never just buy the market blindly. The market is highly efficient at punishing inefficiency.
That is a massive insight for anyone listening. Just because a company's name is on a successful project doesn't mean their core stock will benefit. You have to look at the microdynamics. Okay, let's round this out with Pakistan Telecommunication, PTC. It's trading at 71.65. What is the story here?
So PTC represents the middle ground in all of this. It's sitting in a very healthy upward channel, but its stochastic RSI has recently cooled down to 32.78.
So unlike oil at 95 or the parent company at 0, PTC is just resting. What does taking a breather mechanically mean in the order books?
It means that a wave of profit-taking happened, but it didn't destroy the price floor. The people who wanted to sell, sold.
But the price didn't tank.
Right, because there were enough buyers waiting to absorb those shares without letting the price collapse. The tension on the tug-of-war rope was released gracefully.
Nice.
And because it reset down to 32, it now has the mathematical room to run back up without being immediately overbought.
It is amazing how this data completely shatters the illusion of the headline number.
It really does.
I mean, we started this deep dive looking at a historic 180,014.93, and it just looked like this monolithic wall of economic success. But by actually looking at the pistons, we found completely different realities.
Yeah, totally different ecosystems inside the same market.
We found cement setting a perfectly balanced, sustainable foundation. We found oil and tire stocks with their order books so stretched that the rope is ready to snap on retail buyers.
Yep, the redlining engines.
Right. We saw Telecom resetting its momentum gracefully, and we uncovered those bizarre extremes hidden in the conglomerate sector where a parent company sits at an RSI of 0 while its own property subsidiary just surges.
It really emphasizes that an index is just a summary. If you want to understand the market, you can never trade the summary. You have to understand the liquidity, the order flow, and the momentum of the individual assets.
And that brings us to the most important question for you, the listener, to think about as you watch these charts going forward. We know that gravity eventually applies to everything.
Always does.
Those stochastic RSIs sitting at 95 for PSO and Gandhara Tire, they mathematically have to reset. The rope has to snap back.
It is an inevitability.
But here's the provocative thought I want to leave you with today. When that snapback happens and the smart money finishes taking their profits out of those overheated oil and tire stocks,
Right.
where does that massive pool of cash physically go?
Right.
Does it leave the Pakistan Stock Exchange entirely, causing the 180,000 index to collapse? Or do we see the mechanism of sector rotation?
That's the real question.
Does that institutional cash rotate out of the 95 RSI stocks and immediately hunt for bargains, flowing straight into the oversold holding companies sitting at 000?
That is the multi-million-dollar question. Figuring out not just when the money leaves, but where it flows next is the absolute core of market analysis.
Does the engine blow up, or does the driver just shift gears into a totally different sector? Well, thank you so much for joining us on this deep dive into the charts. Keep questioning the headlines, look for the order books hiding behind the price lines, and we will catch you on the next deep dive.